day to you. Welcome to this panel discussion session where we're intending to discuss on the theme, Building the Future, Sustainable Development at the Heart of Tech Startups. I have a distinguished panel of speakers and panelists who are knowledge experts and practitioners within the ESG space, and will be sharing a lot of their experience and knowledge on ESG investing, on ESG-driven initiatives, and how to key in sustainable practices into business initiatives, especially with regards to startup growth in Africa. We know that in 2021, last year, African startups drew in a whopping $4.3 billion in investment, according to Africa, the Big Deal. And we have about 6 startups touting the billion-dollar unicorn status in Africa. Africa's diverse sectors and the emerging economies hold huge promise for investors globally, especially with increasing penetration of digital technologies and how these technologies are offering a needed disruption to Africa's large and fragmented markets. With the successes of startups like Flutterwave and Paystack that have achieved significant acquisitions and exits, investors all over the world are greatly aware of the massive opportunity for returns that the African market holds. Technology and its increased penetration into the African sector and African society is even offering greater significance to this growth potential. And therefore is expected that through the technological advancement that Africa is experiencing, there will be more germane progress towards sustainable development goals. However, in the light of this growth, it's important to take stock to ensure that startup initiatives are meeting up with environmental, social, and governance needs so as to ensure that they are not harming the environment through their activities, that they are innovating sustainably, and that they are not just succeeding in the short term, but they are set to succeed for the long haul. That's the reason why we're gathered today to share perspectives on ways through which ESG could be incorporated into the business models that startups are utilizing, to grow across the continent. My name is Nicholas Anakwe. I am the business manager of Startup Lagos, a platform that aims at accelerating the growth of startups across the continent. We do this through sharing news and insights on what's going on within the tech ecosystem in Africa. We also endeavor to offer startups visibility and credibility through a lot of our initiatives that we offer through partnerships and collaborations with other stakeholders. And I welcome all of you to this panel discussion session. We're going to start off immediately with the keynote speech, which will be delivered by Henry Ukoha, who is General Partner at IncuMax Incubators. Henry Ukoha, you can kindly take the floor. So he'll be taking off from there. After him, we'll now delve deeply into the panel discussion. He will introduce the speakers for us, and then we'll finally go on to a question and answer session from our audience, and then round off. Henry, please take the stage.
Thank you, Nicholas. Appreciate it. Good day, ladies and gentlemen, once more. This is Henry, General Partner of IncuMax, and it's a pleasure to take this speech for this event today. Globally, sustainability has really been gaining traction around the world, especially in developed economies lately, and it has proven to be a great tool to innovate around some of the socio-economic problems we face as a society, to also innovate around some of the socio-environmental problems we face as a society, and as well as advancing innovations across different sectors, advancing innovation and bettering the lives of societies, basically. And as an African and as Africans, I believe we can also leverage sustainability as a great tool to really move forward our society, more importantly, to address the issues we face as a people, and socioeconomic issues, socio-environmental issues, and the likes. And this is something we've seen in various models work out in developed times. And when it comes to nation building, it's not I believe it's not just the job of the government or the public institutions to really do justice to that. I also believe that private institutions really have a critical role to play when it comes to nation building. And then this is where business owners, this is where organizations and ventures really come into play. And the reason for us to really the reason why we gathered here today is for us to consider and deliberate how can businesses really position themselves as a force for good, not just about the bottom line of the organization, but also how can we use what we're doing, how can we use our value proposition to really drive society forward, how can we use the value proposition that we're offering to really move forward the lives of the customers, the people we interact with. How can we use our position as a business to also lead leadership, to advance discussions around leadership for the environment? How can we use our position as an organization to really address some of the environmental issues we face even in our societies as well? So this way, we're really positioning organizations to not just be there for profit making, but to also ensure that in years to come, we also have a world, we also have an ecosystem, we also have a society that is still livable, that also helps us to keep making profit moving forward, basically. So I know we have a lot of questions, especially as to how can we get started on this, what's the right way to get started on this, and what is the business case basically for us as a business to really incorporate ESG or sustainability into what we do. We have a qualified panelist to really do justice to that, and I'm not just going to let the cat out of the bag. So, but yeah, I will really address the people problem we have and also the environmental problems we have. And without much further ado, I think at this point, I would like to, introduce our panelists. And the first on the list is my colleague, Roman Diaz. He's the founder and the CEO at Satgana. And Roman has an extensive experience, building and scaling startup ventures. And as he has previously, co-founded a startup studio in South Africa. And he has also, he went on to found Satgana. Satgana is a globally distributed venture studio that is on a mission to launch and fund planet-positive startups to build the future of Earth. And they're working in alignment with the UN SDG goals. And this has really positioned Satgana to be and support purpose-driven entrepreneurs with operational resources and pre-seed capital, harnessing technology and innovation to build solutions to the climate and ecological crisis as well. And Satgana has in its portfolio Mazi Mobility, quite an interesting startup to watch. And they are an EV mobility as a service startup, and their mission is to transform current mass transport systems to a smart, efficient, clean, and shared form of mobility by using e-motorcycles, locally known as boarders. You're welcome to the panel, Roman. It's good to have you here again.
Thank you so much.
Next on the list, awesome, man. So next on the list is Dr. Johannes. Sure he has joined us. Yeah. So Dr. Johannes, he currently serves as the co-founder of Venture ESG. Venture ESG is an initiative to push the VC industry on ESG, and it is also supported by over 250 VC funds and limited partners. They are working very hard to make ESG a standard part of due diligence, portfolio management, and internal fund management. And some of the notable VCs they've worked with include Betna Green Ventures, 500 Startups, and Local Growth. And Dr. Johannes is currently, writing 2 books, which I think is very interesting and I look forward to. One is about VC ethics. I think it's an important discussion to have around the VC space. And the other is about diversity, equity, and inclusion in tech. So it's a pleasure to have you on the panel as well, Dr. Johannes. Thank you. And next on the list is Reva Tanya. Reva is the manager Lagos Business School Sustainability Center. Reva is a sustainability practitioner, basically, and she's also a project manager, a teacher, a consultant, and a researcher. She earned her MSc in management from the University of Bradford School of Management in the UK. And prior to studied philosophy at the University of Benin, Nigeria, where she earned her BA honors. Currently, Reva serves as the manager of the Lagos Business School Sustainability Center. She also leads the school sustainability programs and consulting. Reva's work also spans, projects and publications, especially in the areas of sustainability, sustainable and inclusive finance, and so on. So Reva Advisory Group on SDGs in Nigeria. She also serves as on the Network for Business Sustainability, Mezuza Africa, and the Shared Value Initiative. It's a pleasure to have you on the panel as well, Reva.
Thanks, Henry. Hello, everyone.
Next on the panel is Benjamin. Next on the panel is my colleague, my partner, Benjamin Udoku, and so he currently serves as the managing partner at Climata. And Climata is an ESG consultancy that is helping African corporates and startups to find sustainable approaches to their product and services offering. And he also serves as a partner at Incumas. Incumas is our incubator program. It's an ESG-focused startup studio that is helping African early-stage companies build and launch their products and services. He also is a VC scout, helping early-stage tech startups to raise capital. He has also co-led ESG integrations for SaaS, for African startups building SaaS products. He's also a facilitator of an ESG training course with developed at Climata that is focused on helping founders, across emerging markets. So that's the folks we have on the panel, and just at this point, I'm going to hand over to Nicholas to moderate the panel for us. Thank you.
Okay, great, thank you. So for those just joining us, welcome once again. This is a panel discussion webinar. Our theme is building the future, sustainable development at the heart of tech startups, and is brought to you by Startup Lagos and Incumax Incubator in partnership with the Co-Innovation Center and Hazon Technologies. So I'll start off with Romain. My question goes this way. What exactly does ESG or sustainability mean in the context of business ventures?
Thank you so much, Nicholas and Henry, for having me today. Really happy to be part of this esteemed panel about a very important topic. Thank you for having me. And so, yeah, to kick things off, I think indeed it is obviously a very important theme. I think if I take a step back before really delving into this question, I think it is really key to realize the fact that business and the private sector in general is a very powerful force, and that, I think we call impact investing actually positive impact investing or impact businesses, but in reality, any business has an impact, and that impact can be positive, negative, and everything in between. And I think the really interesting thing is to actually measure impact beyond just top line and bottom line, like we measure things from a purely financial perspective. And ESG is a tool, but I think it's important to distinguish ESG, which can be applied, like an ESG lens can be applied to basically any company. Whereas there is also a breed of company that really strive for sustainability and for positive impact. So, for example, a company which is not necessarily striving for positive impact, but incorporates ESG principles in terms of just incorporating environmental metrics, social metrics, and good governance metrics into the way they do things, is a different breed of company as compared to those who are really trying to solve problems as embodied by the Sustainable Development Goals, which I think is a great framework, maybe not perfect framework, but a great framework to really paint a picture of the world that I believe we want to live in by 2030 as per the UN agenda. And so I think a key distinction is really any company can incorporate ESG metrics into the way they do things and the way they operate, even if they don't strive for necessarily positive impact, and then making a difference with companies who really have at the core of their business model having a positive impact, which can be measured by, and there's many frameworks out there, and one of them, and probably the most used one, is the Sustainable Development Goals, and how one company maps out their impact beyond just profitability and financial metrics to specific targets as per the UN Sustainable Development Goals. So I think that's a key thing to distinguish. And if I have to summarize it into one sentence, I would say that ESG is more about doing no harm, whereas positive impact or sustainability is more about trying to do good through the lens of business.
Awesome. Benjamin, what challenges does this approach pose? Startups have come to believe that putting out SDG goals on their website or pitch deck and communications means that they are ESG compliant or that they run a sustainable venture. What does it mean to be truly ESG compliant for a startup?
Yeah, thank you very much, Nicholas, for this. So the thing about ESG compliance is, so Sustainable Development Goals, SDG as we have it, is a wave, right? A lot of startups are jumping onto it, and it gets quite tricky, right? Not taking the time to understand what SDG goals even stands for, and then having to join the bandwagon can have you get all mixed up in that circus. But really, and there are two sides to this, really, because there's startups that simply want to pose as though they're sustainable, like just do whatever every other person is doing, paste SDG goes onto your pitch deck and the website. And then there are other startups that are truly building for sustainability and ESG. And the distinctive feature about this about these two categories of startups lies in standardization. Standardization really goes a long way, right? To really distinguish who is doing what and who is really not getting it done, right? And as a startup, they should really take it as a startup, right? In trying to be ESG compliant, it's quite pivotal that you take a step back to go through the processes, be diligent enough to understand what standards apply to your market, your space, your sector, and then go through the standards in bits, right, in steps. And so that would entail that you have efficiently identified your material risks as a business, right? Because every business is prone to risks, right? Environmental risks, social governance across board. And then you should really take time to understand what risks you're facing as a business, and then seek to discover leverageable opportunities, right? And one standard that comes to mind, right, that is very instrumental in identifying risks is the GRI standard. Global Reporting Initiative standards. And then for startups, of course, startups are there to make money. And then one very important stakeholders that they have is our investors. And so investors would seek to understand the financial material risks associated to a business even before they put money in or before they get to complete their due diligence process, right? And we believe in the years to come, this would be a very instrumental due diligence process for VCs and other funders in the space, right? Trying to really analyze risks from the perspective of ESG and not just the market analysis and space and timing and all of that. So one key standard that comes to mind to help startups identify financial material risks is the SASB standard or the SASB standard. So having done that, another key step, right, in the right direction would be that these startups must be able to develop a roadmap to achieving their set ESG targets. And not just that they are able to carefully weave that into their business strategies and operations, right? Because it's one thing to document your ESG targets to be net zero by 2050, to have made your supply chain sustainable, all of that. Those are very good, audacious milestones. But then the devil is in the detail, right? How can you really communicate that to your stakeholders, employees, customers, clients, board of directors that, okay, we need to figure out how to weave this into strategies just so that we get to practice what we preach. And then lastly, one very key step to being ESG compliant as a startup is that you must be able to effectively monitor and communicate performance over time, right? Because it's one thing to to roll out an initiative or push out a strategy. It's another thing to put in place the right structure to effectively monitor the performance and then tweak where needs to be tweaked or pivot where you need to pivot, right? And then communication cannot be overemphasized, right? If you're doing it right, trust me, we as stakeholder enablers want to see you, right? Because to be quite frank, there aren't a lot of startups, especially on the continent, that are really getting ESG right. So as much as possible, it will be very courageous and commendable that you're able to communicate the performance your muscles achieved over time, right? And again, standards will help you do these things or achieve these things, right? SASB, JERA really, uh, they come highly recommended, right? Thank you, Nicholas.
Great one, Benjamin. I think you're quite right, and definitely it goes without saying that ESG and sustainability is basically here to stay. We know that the ESG push is expanding rapidly, and it will be a mainstay in the not too distant future. But first, it's important to step back a bit. However, this question goes to you. What local and global trends are driving the need for businesses to build for sustainability or become ESG compliant, particularly in Africa?
Great. Thank you very much, Nicholas, and great insights from Benjamin and Romain. I think the trends are interlinked. So not like what's happening globally is quite different from what's happening in African markets. It's just that it's understood a bit different. So on the global stage, you have global agendas like the UN Sustainable Development Goals, which was, would I say, revision or reimagining of the Millennium Development Goals. And the difference this time is that the SDGs were actually developed with different stakeholders, not just among the UN member states, but with business, private sector leaders, development sector leaders, NGOs, all putting together this agenda and saying, as a people, as a, will I say, as a species, we want to achieve these goals by 2030. Now we know that there's a lot of conversation about whether with COVID and everything that's happened, that will still be possible. But there is a global agenda that as a people existing on this earth, we would like to reduce poverty to the barest minimum or possibly eradicate poverty. We would like to have our climate change being managed in a way that it doesn't cause more damage or put more people's lives in danger due to unexplainable climate, will I say, events and having people in the way of that. So we do know that business has been part of this agenda. And at a global level, investors are already held accountable. So you have principles that have come from the SDGs, like the principles on responsible investing. You have other standards about how these implementing these things should be reported, like the SHBC that Benjamin referred to. GRI is a big thing. So on the global stage, you do have that global agenda that is trickling down into commitments for different sectors and different players in society. So even beyond just what investors are doing, governments are also making commitments to how their own countries will achieve these goals, what they will do or what they will not do. I think the COP26 conference really showed that while we know that not everybody's able to run at the same pace, but there is that expectation that whether you're a government, whether you're an NGO, whether you're a business, you're part of this agenda and you should be doing something about it. So that's on the one hand. Bringing it down to local level, saying in economies like Nigeria, Ghana, Kenya, Rwanda, South Africa, we know that these social issues in particular are really in front of us. They're not just in front of us, we live in them. So when we're talking about sustainable development, it's very, very real for people living in economies or communities in Africa. And we know that at the end of the day, we do not really have the institutional or government leadership that some other countries do have. So we really do have an economy or a social system that relies on actions by different sectors. So the private sector in Africa, which may say, oh, they're operating in a volatile environment, they don't have the same kind of institutional mechanisms and support for example, that rewards maybe good behavior. In this case, it will be ESG compliance and reporting and the likes. But we do know that the stakeholders that live with them, their customers, their local investors, their host communities, and this is something that the oil and gas industry, for example, in our own countries have had to learn the hard way, that whether you like it or not, your social, environmental, and your governance footprint does have a real impact. It's beyond just even risk. It really can determine whether your business exists in the next few years. So it's quite pressing now. But I think in our local context in Africa particularly, the social issues seem to be more at the forefront. Although at the global level, we have agendas around things like climate, the SDGs, which have sometimes an overemphasis on the environmental side of things. But in Africa, we're looking at things like poverty, like education, like empowerment, like inclusion of women in financial systems and the like. So usually any business who doesn't understand that these are issues that are material to me, I was so excited when Benjamin mentioned that you have to map what's material to you, because these trends are really part of the place you have to do business, but you have to actually make them part of the way you do business. Referring back to what Romain said, that it's very different from when a company or a business is saying, "Oh, I'm just making sure that all my I's are dotted and all my T's are crossed, so that on the ESG side, I kind of tick all the boxes." But we do need businesses in Africa, and I think that's where the push is going to say, yes, you're a business in Africa, but what impact do you have? Are you the one-eyed man in the land of the blind, where you are a billion dollar establishment, but you exist in an environment where people live on less than $1 a day?
Great insights, Oreva. Yeah. I'm going to Dr. Johannes now. I know you've worked a lot with VCs and LPs. What's your experience working with them on ESG integration? What are the major drivers that catalyze these interests, and why is it important?
Yeah. First and foremost, thanks so much for having me. I'm very enjoying the conversation already and learning from all of you. Perhaps one sentence on background. Most of my interactions are with GPs, so decision makers in venture capital funds between Silicon Valley, New York, London, and Berlin, and LPs who invest in these GPs. So very much important to keep in mind that what we just heard, that there are specificities in the African ecosystem. And I really like your point, Oreva, when it comes to the government doesn't step in the same way on the African continent than it does in Europe, right? Where one of the major drivers that we're already seeing is regulation. So there's something called the Sustainable Finance Disclosure Regulation that's actually already in place, that has been moving VCs in the direction of incorporating ESG, as well as the asset owners, the LPs, right? So if you're a pension fund, you will have to fulfill a reasonably onerous set of reporting requirements to begin with when it comes to what is really an overlapping basket of ESG considerations, right? They call it sustainable finance, but many of the things that we would look at, say scope 1, 2, 3, when it comes to mapping your environmental footprint, are very much what I would call ESG. So regulation is one factor, and that is particularly strong in the European ecosystem. The SEC has been making noises about this, but first and foremost, my trust in the SEC in regulating particularly the private markets is minimal at best, and it hasn't happened yet. And I think that is one major reason why in the community of VC funds I run, which now stands at about 250 VCs worldwide, we are looking at about 75% European funds and only about 15% American funds. And conversations I've had in the last 6 months with big name, like top 10 American funds, and with nobody can make us move in this direction, right? Our business model functions very well. The LPs don't have any say over us because according to the power law, we are so we're basically the only funds that make any money for them. So even the most powerful LPs, so big pension funds in the US, in California, or in New York, or places like the big state funds in Europe or beyond, they beg to have an allocation in our fund. So there's very little pressure, or there's very little potential for pressure on the big name funds, particularly on the West Coast. And that unfortunately has this kind of spin-off effect where, because this industry is driven so much by the fear of missing out, lots of funds in their immediate ecosystem that would look up to them and say, oh, Sequoia and Andreessen are not doing anything, why would I be doing this? So here's actually a kind of break that, particularly in the system that we all want to assimilate, and I think for wrong reasons, and we're going to see that hopefully panning out in the next 5 to 10 years. Silicon Valley, ESG so far plays a minimal role. You can count the VCs that have actively and publicly spoken about ESG on one hand out of Silicon Valley. And often they're impact funds. So funds that, again, Romain, I think your distinction in the beginning was absolutely correct, that are outcome driven and are explicitly focusing on specific environmental or social impacts. And they understand, oh, ESG is another factor that goes hand in hand what I'm trying to do here. And then I think one thing that we haven't mentioned, which is a worldwide phenomenon, is that there's a bottom-up movement towards sustainability that you can see in consumers taking more sustainable choices, be it about thinking more about where their t-shirts come from and where they're produced and what the supply chain looks like, and that there isn't any human rights violations in that supply chain, right? And that obviously also translates into what your employees, both in the funds and in the startups and then also in the LPs, look at, right? If you today, or other stakeholders that are kind of at the bottom, Cambridge and Harvard, their endowments, which are quite big in the venture capital space, they both are on the path to decarbonization, right? Which is just one tiny little bit that really pays into this E factor. And that's partly driven by the students, right? Because the students say, this is not okay anymore. You are destroying our planet and our children's planet, and you're educating us at the same time. So there's pressure from the bottom up, I think, as much as from the top down. And that bottom up pressure is a global one. And I want to mention one last thing, which I think is important, and that's the one thing that I'm a bit more confident about is going to push even the big name funds into this direction. The kind of value chain across early stage venture, later stage venture, growth funds to public markets or asset managers, like big asset managers, is slowly trickling down. So all of the assets that are publicly listed will be ESG rated. There's no conversations about that not happening. So as soon as you are a general catalyst and you're actually taking an asset to the public markets, you will actually risk financial disadvantages by not thinking about what ESG, your company that is now going public, how that affects your company, right? And that is now slowly coming down, I think. So there's a pressure point here where there's very material implications for any VC investor that looks at exits, and they all do because that's the only way of how they're making money.
Awesome. I particularly like, the points you make about pressure coming from bottom up. And I think there's a question for you, Henry, in this regard. Some startups have struggled to find that link or synergy that exists between ESG and their ventures in terms of how they operate and grow, who they serve, that's their customers, and the market geographies in which they are domiciled, and so on. So how can they answer the specific question of why is this really important for me, and how can they lay the business case for ESG integration?
Well, yeah, thank you, Nicholas. I think that's a good question. So yeah, following off, what John has just mentioned, especially the bottom top approach, I think is really one of the levers where we see we're very much hopeful as to what would drive the discussions around companies becoming more responsible and adopting ESG. So basically, for you as a startup founder, it's first of all about understanding your customer dynamics. The people you serve, what are the dynamics, what are their concerns, where are they really, where are they at when it comes to the discussion around sustainability, right? So that should give a hint as to, to begin to make some, foundational, discussion around why it's important that I consider these concerns of my customers, and also use that to really address some of the issues moving forward. So basically, there are different ways to look at, the, making the case for ESG integration for startups, right? So, for example, there have been researches conducted by major educational institutions and even financial institutions as well. So, for example, there is this study conducted by Deutsche Assets Management, and in their study, they analyzed over 2,000 research publications, and they discovered that there was a strong positive correlation between ESG strategies that are integrated into operations and processes of these businesses, and also the financial performance. And they found out that the strongest positive correlations, there was a strong positive correlation, found for businesses that are operating in developing markets. This serves as a pointer in terms of financial performance as to why it's important a startup or a company should begin to consider the discussion around ESG integration. Other factors such as fundraising, just like Johannes hinted a little bit. I mean, investors currently, including financial institutions, DFIs, climate funds, private equities, and some VC firms, and also some impact angel investors. They are really increasingly expecting startups and companies that they are considering for investment, to demonstrate how they deal with the issues around sustainability. So this is where it's important you also begin to, as a startup, find out what are the material risks for you when it comes to the context of ESG around social sustainability, environmental sustainability, and governance issues. I mean, we've seen cases around startups or organizations that have failed in these areas, especially these three pillars of sustainability, and how the backlash has really affected them. So other factors, again, that should be considered while trying to make a case for ESG integration is also when you're considering a startup exit. I know this might really be a new thing for us here in Africa, given the number of exits we've had, especially in terms of larger exits and the likes. So, but a company's ESG performance can really be a deciding factor, when it comes to raising additional capital, visiting to larger private equity funds, strategic investors, and multinational corporations as well, and or even launching an IPO, for example. So, indeed, ESG disclosure requirements on some of these stock exchanges around the world are becoming more stringent. We've seen some of these cases develop in South Africa. We've seen some of these, happen even in the US as well. So, startup exits could also, for you to have a successful startup exit, could also be a good case for you to integrate ESG, because people are asking questions. Some of these LPs are facing firsthand, the impacts of climate change. They can see that, all over the world. So it's important that they begin to also, consider these things. And for one, I would say that ESG or sustainability is really viewed from by investors as a risk management tool. So this also, is being considered when they are making investment decisions. So for a startup founder, it's important you also, see this as a reason for you to also, integrate ESG. So other things from regulatory environment to, market assets, for example, that's a very important one. Market access, for example, it can really so for example, let's take the scenario of African startups looking to expand into more developed economies such as the US or UK that supposedly have a more mature ESG regulations, a more mature. The people themselves, they're already aware of some of these environmental factors, and they're already placing a demand for their services. They're placing a demand for more responsible, product and services offering. So this could really be a winning factor for you as a local or African startup, looking to expand into this market. That can really give you an opportunity to really also key into the market. And this is also important when some of the key industries you might be playing in, there might be few companies really doing things or really listening to what the people are complaining about, or addressing some of the environmental issues or social issues that it's a concern or a risk for that is material for your sector. So this could really provide some sort of opportunity in that regard. So another thing, or another thing for startup founders to also consider, it's labor productivity. So I mean, Gen Zs and millennials happen to constitute of a major part of the workforce globally, and it's also very much true that these categories of individuals also are more attuned or more aware of the impacts of climate change. They're more aware of the concerns. They're more concerned about how climate change is really impacting the world, and they look to do something in that regard. So working with companies that already have a clear roadmap, already have an idea where they're headed, a vision of where they're headed in terms of using their business as a force for good. It gives these talents an opportunity to really gives them an opportunity to really see their work as a means to also actively contribute to the fight, against climate change, or to the fight against social injustice, or whatever case, or whatever aspect of the three pillars of sustainability that is in consideration. So in that way, it helps to that research. There are studies that show that companies with clear-cut ESG goals, they have a higher percentage of retaining and attracting the best talent to come work for them. So these are some of the dynamics that startup founders should begin to consider, especially when it comes to making the case for ESG integration. Thank you.
Great. For those just joining us, we are discussing building the future sustainable development at the heart of tech startups. If you have questions for any of the panelists, you can always drop them in the chat box. We'll reach out through those questions to each of the panelists once we are done with the general questions. Romain, over to you. In this panel session, we have a range of founders, startups, at various stages of growth, some at the early ideation stages, some at later growth stages. Is there a particular stage at which ESG or sustainability should be prioritized?
Yeah, thanks for this good question, and I very much echo what has been said up to now. And to answer this specific question, I don't think actually there is a specific point at which it should be integrated, because I think it should be integrated at any point in time, just at different levels in terms of how much resources and time and effort and money you invest into measuring ESG and impact, etc. So, for example, I'll take the way we do it as a venture studio and pre-seed fund that sources companies. We obviously look at impact as one of the criteria that we look at. We look at impact, we look at commercial potential, we look at the team, and then we look at the partnership fit and whether we see ourselves working with the founders. And obviously, we cannot do a deep impact assessment for every company that we receive, because we receive hundreds of them that apply to join us for funding and for building their company with us. So obviously, the initial screening is a lot more superficial, I would say. It's more like, do we think that this company, based on what they're telling us in their pitch deck, can have the positive impact that they're claiming? And do we think that there's real intentionality? That is one of the things that we look at. Is impact more a side effect, or is it more like really intentional in the company or in the founders? Because most of the time it's just like 2 or 3 founders that apply very minimal team. So we really check about intentionality. And then once we get a bit more into speaking with the founders, assessing the investment opportunity, then we check a bit more in detail, mapping out the positive impact in terms of the SDGs, going at a more granular level in terms of the targets that they're hoping to have an impact on, etc. And then once we make an investment decision, then it becomes more beyond due diligence. It becomes like portfolio management. So then we implement new frameworks for impact measurement and management, such as so PRI is one framework, but that's more for responsible investing. But more then for impact investing, we look at the impact management project, which is sort of an umbrella collection of different frameworks that enables very deep and comprehensive assessment of the potential impact of the startup. But that's still very much early stage. So you cannot obviously invest as much resources and time and effort and money when you're super early stage. And as an entrepreneur, you want to do good and you have true good intentions, but also you have to survive, because we all know that startups are fragile by essence, and so they have to have that positive impact, which is really embedded in the way they do things, but also they have to survive and make sure that they have enough runway to make the company just basically just beyond surviving. It's just like being born in the world, because we all know that it's like a baby. It's very fragile, so it needs a lot of nurturing, and it needs to just survive by catering to its basic needs, basically. So at the beginning you cannot invest as much resources, but then the more you grow, if you survive, and the more you can invest into actual ESG monitoring on all levels, from environmental, social, and governance, and then like at a more granular level on all the metrics that you can look at, and then in terms of impact management. On our end, one framework that we look at more from an ESG perspective than impact perspective is B Corp. We intend to ourselves as a fund become a B Corp company, and we would like as much as possible that our portfolio companies also become B Corp certified, because we think it's a good framework for looking at the environmental, social, and governance perspective, with like well accepted, well recognized, and well uniformized as well framework globally. So that is the way we do it. And then obviously once you become big and you become like a corporate, and maybe you get you get listed on a stock exchange, or you get acquired. So if you get acquired, that's also another perspective to take into account, is can you still not have a mission drift, and can you really be integrated within another company while being true to your ESG and or impact mandate? So these are a couple of the things to take into consideration, but short answer to this is, I think at any point in time, it should be taken into consideration, just obviously with not the same amount of resources that you can invest depending on the stage at which you are.
Yeah, quite important. At each stage, it's very important to take into cognizance the role of ESG. Yeah. We also know that traditionally, a lot of startups, or rather there's that assumption that when we talk about ESG, that we speak of it only in terms of climate tech ventures, such as those that we see in the clean energy space. But does it also apply to startups in other sectors such as fintech, retail, that are very high performing within Africa? And are there any case studies? This is a question for you, Benjamin.
Yeah, thank you very much, Nicholas. And this really stands to be true, right? Especially in Africa, we see a lot of companies, or the mindset in Africa is, as far as you're talking sustainability, you must be from the clean energy sector, right? Unlike other clubs in Europe, where ESG has spanned across various verticals and various sectors, right? So, yes, it's quite frankly, the conversation is quite new, right, here in Africa. So, yeah, there's a little bit of nuance in our understanding about ESG. But you're absolutely correct. ESG applies to all kind of startups, regardless of your sector or your space: fintech, proptech, healthcare, edutech, you name it. Now, why is it so? As a business interacts with the environment and people, right? As long as you interact with either the natural environment or built environment, doesn't matter. And as long as you work with people, right, from your internal stakeholders, board members, investors, employees, to external stakeholders, right, you to like customers, there's a place for you in ESG, right? Some of the social aspects of ESG that any startup can apply regardless is the diversity, equity, and inclusion, right? And one thing about ESG is truly a value creation engine, right? And we're talking long-term value creation engine that once it's unlocked, right, at the core of your business model, it can serve as a competitive advantage, a unique value proposition across board. And so startups need to think differently, right, about how to innovate using ESG frameworks, because it is here to stay. And if you want to be distinctive in the market, you should start thinking that light. So yes, I have about 2 case studies, or I know about 2 case studies of African tech companies, right, that are beginning to make the strides in becoming ESG compliant, right? So there's a PropTech startup that helps construction project managers with this software as a service project management tool, right, which helps them to effectively monitor and track activities on the construction site to drive efficiency. Now, given the types of clients they serve, it is safe to say that by extension, they also have a close interaction with the natural environment, right? Because we're talking about construction sector. Now, here's the data out there, right? The building and construction sector globally emits between 35 to 39 CO2, right? Globally. Now, the question is, how can they help reduce the emissions while offering immense value to clients and stakeholders? And now, on their product, on their software products, there's this feature that grants them the ability to measure carbon footprints on each project, right? So a project manager can simply measure the carbon footprint of its projects in real time, right, and actively report through the platform. Now, what value is this bringing? We're talking about integrity for stakeholders, right? Because we know that the carbon emission of built environments is skyrocketing year on year, right? And so for stakeholders, it stands as a good value prop for them to communicate how sustainable their buildings are, their projects are, and they as a company, right? And that's one very important case study, right? And another case study would be a mobility tech startup. Yeah, this mobility tech startup, they are modernizing intercity mobility and logistics across Africa. And one thing they're trying to do is they want to help mitigate emission travels, the carbon emission of their travelers, right, on the platform. Now, here's the data. The data is that the transport sector accounts for 1/5 of global CO2 emissions. Now, since the entire transport sector accounts for 21%, road transport sector is like 3/4 of total transport emissions. So we're talking about 15% total for CO2 emission, just road transport alone. So you can see how huge the emissions in that space is. Now, this startup, they are looking to help mitigate the impacts of CO2 emissions across their plants and supply chain and value chain, right, by empowering themselves and then their passengers or travelers through tree planting initiatives, right? So we see these things thrive very well in Europe and North America, where, you know, lots of tech companies leverage tree planting initiatives to sort of mitigate, reduce their net emissions, right? And then be on a path towards sustainability, right? So this is an opportunity, right, for road travelers to offset their travel emissions per trip, and the cost is extremely minimal, right? So, and then there's the socioeconomic benefit of this, right? Because these trees will be planted in rural areas, right? Carefully monitored, carefully tracked, and then in these rural areas, it serves as it brings an economic value, right, to those dwellers in those areas, right? So we're talking about trees that can, for example, shea butter, right? Shea butter emits quite a minimal percentage of sequesters quite a minimal percentage of CO2, but again, that's its economic value, right, for these dwellers. Sorry. Yeah. So these community members can choose to sell this shea butter, right, to their local communities and then get value for money. So across board, this is to say that ESG applies to your startup regardless of the sector you are space you are. You just have to look inward and look for how you can, use ESG framework to sort of drive value for whichever stakeholders you find yourself playing with, right? So that does it.
Oh, thank you. Thank you very much. Dr. Johannes, I think this question goes to you. We know that last year, particularly, Africa really, drew in quite a lot of investment. I think 2x of what was drawn in 2019. And the sectors that really performed well were fintech, and many other fintech alone drew in more than half of investment across Africa. Yeah. Now, in your work with international VCs that are integrating ESG, what general pointers would you advise startups to pay close attention to in order to align better with investors?
So from a startup's point of view, they can expect being scrutinized in the due diligence process going forward when it comes to both their financial performance and their vision and their product, as well as ESG and, if applicable, impact, right? However, as there is no agreed upon standardized process at the moment, right? There's various frameworks that were mentioned on the call, from GRI to PRI to SASB, when it comes to measuring certain types of ESG/materiality. But I don't think many VCs, even in the foreseeable future, will make a startup fill out a comprehensive ESG questionnaire, particularly when they're early stage in the due diligence process. The questions are going to be around things like, do you think about diversity when building your company? Right? Not, do you have a diversity policy? How can I ever, and hopefully that's what we're working on in our community, how could we expect a 2 or even a 5 or even a 10 people team to have a diversity policy? And how could we expect that to be meaningful, right? It is about figuring out, in particular, how the founders think about ESG, right? And that ultimately boils down to conversations around values and mission and purpose, and what it is that motivates them and what it is that drives them, right? So what we hope is that as a startup that's authentically focused on building a company that, for instance, sits in its community in a sustainable, and not only environmentally, but sustainable as a business way, that should be rewarded, right? Because we do think that the blitz scaling, move fast and break things model is coming to an end. And hopefully the West Coast investors are waking up to that, or we're just going to roll over them. Because it still seems like that is a model that is looked at favorably, and for the sake of our world and all of us living on it, I'm quite confident, given that this community has been growing from when I first started looking at how VCs think about ESG and frankly also impact about 18 months ago, 2 years ago, and found very, very disappointing answers around very few people having ever thought about incorporating and integrating ESG in their processes, to now every single major top European fund is either already doing something on ESG or very actively thinking about how to roll out a strategy, or, and the news of that have just come out yesterday, one of the biggest European funds, Atomico, they just hired a full-time ESG person, right? So all of that to say, startups should be prepared to answer questions around ESG as early as the due diligence process. And then actually, from my perspective, should ask for support, right? This idea that the VCs are running around and propagating, asking how can I help, or how can I be helpful, or how can I add value? Yeah, for once, there's an opportunity here where actually I, as a startup, would say, oh, look, you just told me that I'm not particularly good when it comes to figuring out my thinking about my environmental impact. How about you tell me how to do it, right? And how about you give me a little bit more money to do a carbon accounting, because that'll cost me 20 grand or something. So I hope that there's going to be a very nice relationship where the VCs see the value, as we've now heard again and again, I think today, in thinking about ESG across the startup journey as early as a pre-seed company. And the startups themselves feel confirmed in their choices of building companies that are more sustainably, again, in the wider sense of the word. And that there's finally a symbiosis between the startup and the VC, where the VC not just runs in, wants to get into the tight deal, drops money and disappears again, but there's actually working together. And I feel ESG is a good opportunity for that to happen.
Great. Oreva, my question goes to you. What are some of the design challenges that you have encountered in your work with businesses, especially in the fields of sustainability consulting and the circular economy?
Thank you, Nicholas. And I really wanted to follow up on what Johannes has just said about startups really being bold enough to ask the VCs and those who claim to want to support them that this is an area I need your support. I think that's very, very instructive because maybe I should start with one challenge that we see, especially with SMEs, startup in our context, is they think this sustainability agenda and this ESG thing is just too big for them. Like, leave it alone and let the larger multinationals, those who are already on the stock exchange, let them deal with these issues. It's not really what I'm trying to do now. I'm trying to, like Romain said, I'm trying to survive. I'm in an environment where I don't have much support, have multiple regulatory challenges, I have multiple operational challenges because I'm operating in a market that doesn't have the same kind of infrastructure that some other economies have. So yes, most of these organizations, whether we're looking at startup and SMEs, do like the idea. The founders, the entrepreneurs who are driving these businesses do adopt this idea of sustainability. They believe that it's important. They believe their businesses should be playing a role, but most times they're scared that it will be a distraction or it will be a cost center. So it's something that's just going to drive up their costs if they start, for example, trying to get the consultants to do GRI materiality mapping. They don't even believe they have the time to do that. So one of the, maybe on the other side, apart from looking for the challenge the challenges, is looking at what we actually advise them to do, which is start small. I liked when Dr. Johannes mentioned that, you may not really need to have a policy, but you probably need, as a founder or someone who's driving this enterprise, to have some sort of vision or clear intention around these issues, even if you don't have a big ESG strategy integrated into your 5-year, 10-year strategy for the business. But another challenge that we're seeing is that the regulatory environment is really, really slow in catching up to these issues. But we also see that there's a tendency for some of the regulators to kind of leapfrog, especially in our own context. So, for example, there's the looking at what happened in Kenya around plastics, where all of a sudden there was a rule that plastic bags are completely banned. No much talk before that, but they just brought it down and put it on the table. So a lot of businesses who were probably relying on that kind of material for packaging were in a bind. But it was mostly because they had not ever considered that something like that would actually become a regulatory issue for them. In Nigeria, for example, in the finance sector, there's been a lot of movement around that issue. So in the banking sector, for example, we already have the Nigerian Sustainable Banking Principles. And now we're seeing some movement around even the RSEC, saying, oh, we want to probably have a standardized way for companies to report on both financial, environmental, social, and governance issues, not to the regulators and to their investors. So while we know that there's not much regulatory attention being paid to what startups are doing, they seem to be on their own. But there is that possibility that you may have one, let's say, policy leader, one government official who understands this and makes it a priority, and all of a sudden, within a year, it's something that these businesses have to deal with. So that's one of the challenges: the fact that they're not being so proactive. But at the end of the day, it's usually because they don't know where to start. So I'm going to also piggyback on the issue of seeing it more as something that they have to report on, and then looking at these reporting metrics as something that are so far-fetched for them as a startup, right? So when we're engaging the larger companies, probably those who are local branches of multinationals, their companies have these commitments and templates at a global level. So all they do is need to train those who are on the ground in Nigeria or Ghana or South Africa to just follow the same standards. But for companies that are mostly indigenous and then bringing it down to startups, it looks like something that is really too difficult for them to do. So sometimes we do, encourage them to look at it from a mission perspective. In Nigeria, for example, there's a lot of movement around people looking at enterprises as social enterprises. That yes, you have a business, it has to survive financially, but it should be adding social value. Maybe because we have a lot more social issues that people can relate to, like the quality of education, access to healthcare, issues around youth empowerment, poverty. So we kind of encouraging the startups or companies or SMEs to look at it through that lens it makes it seem less threatening, and also makes them think, oh, probably I just need to look at what I'm doing a little bit differently. So one example I can give was working with Oxfam and our Enterprise Development Center. We were teaching some of these SMEs that had already gotten quite huge investments from European funds and operating in Nigeria. One of them was she runs a furniture company. So through the circular economy trainings and the sustainability sessions, she then thought, okay, maybe I don't actually have to change my business. I'm running a furniture company. I do have customers I have sold products to probably years ago, and they may want to upgrade, they want to change something. She started then taking back old furniture where her customers could bring back an old couch set or an old table or old furniture back to her. They would just add a little bit more money and get new furniture. And then the old furniture she used to train young girls in her community to refurbish furniture. So at the end of the day, that became a competitive advantage for her. She had more sales because these customers who had already bought products and wanted to maybe get a new set or exchange came back to her, and that was at least more sales for her. By the end of the day, she was empowering these young ladies with more skills. And in her own, on her business side, she's reporting that as real social impact that is really still aligned with the purpose of her business. So also trying to show people that while this looks like a very big deal, there are small things that you can do within your business, within the purpose of your business, that will actually make you ESG compliant anyway. But at the end of the day, it also adds value to the business, and that value can be communicated to the funders you're looking to your investors, to the regulators. Yeah.
Great insights. I really love the way you drew up some case studies to try to explicate your point better. That's beautiful. Dr. Johannes, I'd like to direct this question to you just before you pop off. What ideal steps or approaches can VCs take to mitigate, the lack of technical expertise within VC firms in leading the ESG transition? We know that not many VC firms are very conversant with, ESG. Some have a hazy understanding of ESG. So what ideal steps or approaches do you suggest to help mitigate that lack of technical expertise?
Yeah, so I think this is not a VC problem at all. There's a general lack of expertise in the economy and in the business world when it comes to what ESG in the particular sector, company, geography means and should mean at the moment, right? That's why PwC, I think, is hiring 200,000 people worldwide that are going to focus on ESG. And this is just one of the bigger numbers that you find. And they don't exist. I think there's a massive need for upskilling, which is, I guess, some of the work that Oreva is doing and business schools are doing. And there's been a lot of research around sustainability and ESG for years, right? So it's not that the business schools wouldn't necessarily be equipped, but the kind of tide is shifting, as we've been discussing today, that there's more need for people to really be experts in this right now. And VCs, I think, are a particularly badly educated bunch, right? Particularly thinking about, depending on the ecosystem, who rules these VC worlds. In Silicon Valley, we're now in generation 3, 4, 5, where most of the high-ranking VCs are former entrepreneurs. So they do know how to run a business and actually build a business and scale a business and raise money. So the kind of relationship between the founders they invest in and them is a much stronger one, because they know what the problems are that these people encounter. In the European ecosystem, and I imagine the African ecosystem might be closer to that to a certain extent, we're still very much stuck with consultants and investment bankers who have no idea of what a startup is and how a startup works. And that has led to all kinds of problems where the first wave of European, and I'm particularly thinking about how the German ecosystem started, the first wave of European VCs was equipped in that particular way. They were all financial people thinking mostly about the bottom line. And what happened is, partly because there was much bigger risk aversion as well, a lot of the stuff that happened in Europe was just copycats. like first, second generation European, what is now unicorns, was just copycats from the US. So the biggest German startups, or the two biggest German startups that are now in the kind of main, they all went public and are in the main kind of share DAX, are a kind of delivery clone and an Amazon clone, right? Because that obviously worked somewhere else, and that was clearly going to drive revenue quite quickly. All of that to say, we're now at a point where these people are still in these positions of power, and not only do they not understand startups, they also really don't understand ESG, impact, sustainability, whatever the specifics are of what we want to focus on. And fortunately, I think there's quite a few communities, and the one that I'm engaged in and co-founded, Venture ESG, is one of them. But there's two alone in the kind of English-speaking Western ecosystem that I know of, who are trying to equip VCs, partly by kind of bringing them in one room, and one of them is further ahead, right? I mentioned that Tomiko just hired a head of ESG, and she really does know what she's talking about. And bringing people like her in a room with people who are interested, wanting to start, but don't know how yet. I think that's the kind of, because this is very, very early days, that's what we're at the moment. And then organizations like the PRI and SASB, as well as regulators, need to step up their game as well, right? There's a specific need, and we're talking to SASB and the PRI in particular, and they know, but their processes are reasonably slow. So the PRI is quite explicit about the fact that they're interested in thinking through what exactly their frameworks would need to be adapted to be really fit for purpose for VC, but it'll take them a moment to get there. And SASB's process is even more complicated. So we can't really be dependent on this for now. We kind of have to, within the VC community, with the necessary experts from the outside, get together and learn together. I think that's what I would say VCs can do. So in the African ecosystem, start another group. Get in touch with me, let me know what you're interested in learning, and I'll help you set it up and kind of point you towards the directions that we've over the last 18 months learned are important as the first little steps. But get together, learn together, and leave your competitive focus out of the room for a moment. I think it's quite good to see that that's what's been happening, where everyone's struggling with the same problems. We don't all need to solve them ourselves. Let's work together for once.
Awesome. Thank you so much, Dr. Leonard. He will be leaving us early because he has another engagement. Thank you so much for coming on the panel. I'll switch over to Benjamin. We just spoke about a little haziness in understanding of ESG, and that also reaches even into board members and executive members of various companies. There's generally low adoption and enforceability of ESG among startups. Have you had similar experiences while consulting for startups, and how do you think this can be addressed?
Absolutely. I mean, that's a very key question in this conversation for startups, especially. So we've had this experience where the founder of the startup had a total buy-in, right, for us to integrate ESG into the company. But guess what? His board members basically shut it down. And the reason why they shut it down fundamentally was that they couldn't see the value prop. They couldn't see the need for ESG integration. And the cause of that at core is that they just don't know what ESG means. And they're not willing to admit that they do not know what ESG means. That's the thing with board members and the likes. And so such a tough conversation, right? Because the founder was sure that they would need it in the long run, right? So we're talking about a startup that serves the global markets, and across the emerging markets like Africa, they will fairly succeed, right? Because they do have a good value proposition. But if they're to scale outside of Africa, say other developed markets like the UK, US, they won't survive. And ESG would be that Trojan horse, or that single feature that would make them become a mainstay in those markets. The founder totally understood this, but the board members basically shut it down again because they couldn't relate, right? So what I'm trying to say is, it is a fact that board acknowledgement and board buy-in goes a long way to determine the progress of ESG adoption. That's a fact. And so board members who are truly committed to the growth of the business, because again, to be quite frank, we've seen some board members who sort of have this streamlined approach to what success means for the business, and they want the founders to strictly adhere to it, not willing to adjust or be quite flexible, right? So board members who truly are committed to the growth of these businesses, and quite frankly have a vague understanding of ESG, the ideal thing to do is to be very open and sincere enough to learn about what ESG means as well as its prospects. It's very, very fundamental, and that's just a straightforward answer. They need to learn, right? Where we came across these reports, where it says that globally, I think about 32% of board members are knowledgeable about ESG, and the rest are just going with the flow, right? So again, we know that the most successful companies are learn-it-alls, not know-it-alls, and this should not just cut across employees and founders. This should also, cascade into board level buying as well. And so they must seek to prioritize the unlearning and relearning process or phase in order to come into the understanding of what ESG truly means and how they can inculcate that into the company strategies and objectives and vision and all of that. And then the rest should be history, right?
Okay, great. Romain, given that ESG principles and practices are, a systemic approach that helps startups to address various aspects of their business operation while also having a ripple effect on stakeholders across the value chain. At what point can startups take the lead in assisting, players along the value chain in making that needed transition to sustainability and ESG? And why is this critical to the long-term viability of these startups?
Sorry. Yeah, so I think the earlier the better, for sure. Relating to what I said earlier on the fact that it's just related to how much resources can be invested in this, because obviously sustainability and ESG is more of a long-term outlook on things rather than a short-term. And as I said earlier, it's also about surviving as a startup. But again, the earlier the better. All the more as I think we are at a very interesting time in the history of business, which is that I think there used to be maybe a bit of a trade-off between being profitable and doing the right thing or being impactful. So I think in the previous narrative of the past few decades, it was if you're going to do good, then you're going to have to sacrifice profits. And then I think there's been more and more examples of companies actually doing the right thing and having a positive impact that were actually starting to be examples of very profitable companies as well. And I think what's happening at the moment and what's going to happen and accelerate in the next years and this decade in particular is the fact that the most successful companies of this decade are going to be the ones that really incorporate ESG, really have impact embedded into their business model, relating to what Johannes said earlier on the fact that it's not only top-down with governments and regulations and corporates, etc., but also bottom-up with both consumers and also talent and the younger generation wanting to work for purpose-driven companies. I think all of this together is putting impact-driven companies and ESG companies at the forefront of a new generation of companies, which is really about having a positive impact, doing the right thing, and being profitable. And we see it, and that is obviously more on the long term than in the short term. I think in the short term, it's always possible on a quarterly to quarterly basis to be more profitable if you don't really care so much about impact and ESG metrics. But in the long run, I think goodness compounds, and that it also compounds in returns. And so I think it's a really interesting point in time at the moment. So very much excited to see all this shift happening and being part also of this new paradigm of companies whereby profitability is also linked to other metrics so that we can utilize the business sector and the private sector as a force for trying to create a better world.
Great. I have a last question for Reva, but before then, those who are on the call can drop questions if you have, can drop it in the chat box, so that once we're done with questions, we can pick up questions from the audience that we could ask our panelists. So Reva, my last question to you goes this way, and last question for the session. In other parts of the world, it was unique when you spoke of the harsh regulatory challenges that a lot of startups in Africa face. We know that in other parts of the world, such as the US and Europe, policies have actually been very instrumental in increasing the adoption of sustainability among businesses and helping them to reduce the occurrence of greenwashing. A case in point would be SEC regulations in the US market. In Africa, particularly, what role can policy advocacy play in promoting sustainability adoption?
Okay, thank you, Nicholas. So I think this is where African startups actually have an advantage in that in our context, there is actually the opportunity to influence or even possibly create policies that are good for your business. In some sectors, we have case studies of sectors where this has been done and where it has made the private sector or the businesses more of partners with government in the advancements of these principles. I know in Nigeria, the Nigerian Sustainable Banking Principles is one shining example where the Bankers Committee in Nigeria, meaning the heads of banks, the banking industry, commercial banks, came together and actually developed the sustainable banking principles alongside the Central Bank of Nigeria. And then the Central Bank of Nigeria was given the responsibility to regulate them across all their institutions. So obviously the leaders, the banks which actually drove this, were at the forefront of this, end up not having to have a regulatory, would I say, a challenge, too much of a challenge, ensuring that they're complying with those regulations because they were part of developing the regulation anyway. So I think in terms of what our own startups, especially startups, should be doing is that, we're operating in an environment where something can come out of the blue and just make your business non-existent. I think we saw that with the case of cryptocurrencies and the reaction of Nigeria's regulators around that. And when you look back at that situation, it wasn't necessarily that the intention of the regulators was just to kill the businesses that were in that space, but it was because they didn't really understand the value that was there. They didn't understand, they saw more of the negative impacts. And because really another issue is that the actors or the players in that space were not talking to the regulators at all. So policy advocacy is a must. I know for those of us who are probably in tech, you're really in our own world, or you're trying to survive, like Roman and I had mentioned. But it is important in these volatile, very uncertain operating environments. Even if you don't, but my advice would be that the startups and entrepreneurs don't have to do this as individuals. It will be a huge uphill climb to try to do it as individual ventures or businesses. And it will be seen also as, it won't be received with the full value that it brings, because one policy advocacy is about, it's not just about what's good for my own venture, it's not just about what's good for my own business, it's about what's good for the sector and eventually what's good for the economy and the society and the citizens in the long run. So for example, Nigeria just launched the Agenda 2050, which is the country's own development agenda. There is an aspect of that tech startups, if we look at, can help government by saying, oh, if you give us this kind of regulatory environment, we can actually help this goal be achieved faster. We can actually grow faster. We can create this number of jobs. We can create this number of income in terms of income taxes. But when there is no communication at all between the two, will I say, between this huge body, which is government, and most likely in our context is seen as the big bad guy, but whether we like it or not, they are our government. They will still, they still have the responsibility to regulate the economy and to really create an enabling environment. But we have also the responsibility in this case to let them know where they should be supporting. And I think for it, I'm not sure yet we have any advocacy groups around startups in Nigeria. I know some other countries do have those kind of conversations, but even if you look at the larger examples, Nigeria, for example, has the Manufacturers Association of Nigeria, which engages actively with ministries that have a lot to do with trade and investment in the country. So that, I think, would be the way to go, that startups come together and be and advocate for policies that they believe will help them be more sustainable, and then communicate very clearly the value, not just to their business, not just the economic value they will create, but the value that comes back to the country and to the government eventually.
Okay, thank you very much, Oreva. If there are questions from the audience, we could have them in the chat box. If we don't have questions, we would move on to closing remarks. Do we have questions? Okay, so possibly we'll move on to closing remarks. It's been awesome having you all on the panel. I'll hand over to Henry to, close off the session.
Yeah, thank you, Nicholas, and a big thank you to everyone on the panel. Big thank you to you, Romain. A big thank you to you, Oreva, and Johannes, and Benjamin, of course. It's been a lot of insights that have been shared on this panel, and I think the startup founders and entrepreneurs on the call would find this valuable. I know the discussion around ESG and sustainability, especially here in Africa and Nigeria, of course, is still in its very early stages. But conversations like this is also one of the ways we are trying to advance that discussion around sustainability, and also try to bridge the knowledge gap that really exists across our stakeholders in the ecosystem. So thank you so much, gentlemen and lady, for your insights, and we'll stay in touch. Thank you to the audience, and please, it will be an awesome, it will be great connecting with any of the folks that are looking to also maybe ask further questions around how we can go around integrating ESG or sustainability into their businesses and the likes. I mean, we'll be more than happy to have those conversations even after this event. So thank you, everybody, for your time, and we'll stay in touch.
Thank you very much. All right, bye.
Bye, everyone. Thank you so much. Bye-bye.